pleasant day, everyone. I am Ashley Elisha B. Daga-ang, BSMA 2 from Econ 122, 7G106, 2:30 to 3:30 p.m. TTHS. This is my assignment number 4 titled Business Cycle and Balance of Payment. So first question, illustrate and explain thoroughly the business cycle. Business cycle is also called the economic cycle. The business cycle can be visualized as a roller coaster ride for the economy, with periods of highs and lows. It's a recurring pattern of economic expansion or growth followed by contraction or decline. Here is a breakdown and illustration of the 4 stages of the business cycle. The first stage is expansion. Expansion is the upswing phase, often referred to as a boom. The economy experiences strong growth. During this stage, there is an increase in consumer confidence. As a result, people spend more money and pay their debts more comfortably. Many companies grow and thrive in this stage. Expansion is characterized by first, increasing GDP, second, rising employment, third, increased income and spending, fourth, profit growth, and fifth, low interest rates. The second stage is peak. The expansion doesn't last forever. The economy reaches a peak where growth starts to slow down. This is the turning point in the business cycle at which output stops increasing and start decreasing. At this point, these economic indicators cease to rise further. Many businesses and individuals may re-examine their budgets in anticipation of a decline in economic activity. This can be caused by factors like first, inflation, second, interest rate hikes, and third, labor shortage. After knowing about the peak stage, now let's go to third stage, which is contraction. Contraction is the downswing phase, often referred to as a recession. During this stage, business owners focus on finding ways to improve their financial situation, such as how they can save money or become more competitive. Economic activity weakens, evidenced in first, decreasing GDP, second, decreased income and spending, third, rising unemployment, fourth, profit decline, and fifth, increased interest rates. Lastly, the fourth stage is through. This is the bottom of the economic downturn. This is the turning point at which a recession ends and output start increasing again. During this stage, supply and demand decline significantly and employees do not have nearly as many materials. It's common for companies to lay off employees or close in the true phase. It's characterized by first, stagnant or slightly increasing GDP, second, low interest rates, and third, low employment. To be able to raise again, recovery phase is a must. Following the through, the economy gradually starts to improve, entering a new expansion phase. This marks, or the recovery marks the beginning of the next business cycle. Second question. Give a specific example or situation in each cycle stage. To illustrate the business cycle, let's imagine a company called Acme Widgets, which manufactures gadgets. In expansion stage, here is the scenario. Acme Widgets experiences a surge in demand for its gadgets due to a new and popular product launch. They expand their production capacity, hire more workers, and see their profits increase significantly. So in this scenario, the economic indicator is GDP is rising, unemployment is low, and consumer confidence is high. So in second stage, which is in peak stage, this is the scenario. The market for Acme gadgets becomes saturated and the initial excitement for the new product starts to fade. Competition increases and Acme faces challenges maintaining prices and profit margins. So the economic indicator for this peak stage is GDP growth starts to slow down, inflation begins to rise, and interest rates might be increased by the central bank. In contraction stage, this is the scenario. Due to the slowdown in demand, Acme is forced to reduce production, leading to layoffs and decreased revenue. They might also face difficulty securing loans due to higher interest rate. The economic indicator in this situation is GDP is contracting, unemployment is rising, and business are generally cautious about investing. Lastly, in through stage or in the fourth stage, this is the scenario. Acme has implemented cost-cutting measures and diversified its product line to adapt to the changing market. They start to see a slight increase in demand and may even rehire some laid-off workers. The economic indicator of this through stage is GDP decline slows down or starts showing slight improvement. Unemployment may stabilize and interest rate could be lowered by the central bank to stimulate the economy. To recovery, here is the scenario. With continued adoption and improvement, Acme start to see a sustained increase in demand and profits. They may resume expansion plans and invest in new technologies or product development. The economic indicator for recovery stage is this marks the beginning of the next expansion phase, with GDP growth, falling unemployment, and rising consumer confidence. Third question. What is balance of payment, and explain your understanding in your own words. The balance of payment, short for BOP, is a comprehensive record of all economic and financial transactions between a country and the rest of the world over a specific period, typically a quarter or a year. It's essentially a giant accounting sheet that tracks all the money flowing in and flowing out of a nation. Think of it like a household budget for an entire nation. There's income coming in, or money earned from exports, foreign investment, and etc., and expenses going out, money spent on imports, investment abroad, and etc. The BOP aims to show whether a country has a trade surplus, more money coming in than going out, or a trade deficit, more money going out than coming in. Ideally, the total money coming in should be equal to the total money going out. The BOP strives for balance, meaning the total value of inflows should ideally equal to the total value of outflows. In reality, this perfect balance is a common. However, significant imbalance can signal potential problems in a country's economic health. Lastly, fourth question. Give example problem or situation, including its complete computation and solution. So this is the sample problem. A Philippines balance of payment or BOP for a specific year is given below in millions of Philippine pesos. Export of goods and services is 250 million. Imports of goods and services 300 million. Investment income 10 million received from foreign investment and transfer payment 5 million sent abroad for aid and remittances. Foreign direct investment or FDI 40 million pesos inflow. Portfolio investment 20 million pesos outflow. The task is first, calculate the current account balance, capital and financial account balance, and overall BOP balance for the Philippines. Second, analyze the result and interpret their meaning for Philippines' economic situation. For solution of the problem, to calculate in terms of current account balance, the formula is current account balance is equals to export minus imports plus investment income minus transfer of payments. So to distribute the number that belong here, current account balance is equals to 250 million minus 300 million plus 10 million minus 5 million. Current account balances is equals to negative 45 million pesos, indicating deficit. In terms of capital and financial account balance, capital and financial account balance is equals to FDI plus portfolio investment. So, capital and financial account balance is equals to 40 million minus 20 million is equals to positive 20 million, indicating surplus. For the overall BOP balance, since the BOP should balance, the total inflow must equal to the total outflow. We can use the formula. Current account balance plus capital and financial account balance is equals to 0. Therefore, negative 45 million plus 20 million is equals to negative 25 million, indicating deficit. The interpretation for the answers is to interpret the result. In current account, the negative current account balance indicate a trade deficit. Philippines import more goods and services than it exports, leading to a net outflow of money. While the positive investment income partially offset this, it's not enough to overcome the trade deficit. In terms of capital and financial account, the positive capital and financial account balance shows a surplus. This means that there is a net inflow of capital due to foreign direct investment exceeding portfolio investment outflow. While the overall balance of payment, despite the capital and financial account surplus, the overall balance of payment shows a deficit. This suggests that the net outflow from the current account is not fully offset by the net inflow from the capital and financial account. This deficit could lead to decrease in Philippines' foreign exchange reserve or put downward pressure in its currency value. In conclusion, although Philippines is attracting foreign investment, its persistent trade deficit raises concerns about its long-term economic sustainability. Policymakers or government might need to address the trade imbalance through various strategies like promoting exports, encouraging domestic production, or potentially adjusting exchange rates. That's all. Thank you.